to welcome you all to the first in what we expect to be a series of research conferences organized by the Institute for Financial Management Research on financial systems design. The fact that all of you have taken time out from your busy lives to be here is indicative to me of the importance of this topic for our country, as well as the belief that carefully thought through research program will help us make sense of all of the confusion and the to be or not to be questions that are in front of us. The objective of the research program is to empower our policymakers so that they can then take the necessary steps towards a financial systems design that is appropriate for us at this point in our history with a lot more clarity and confidence. As we have informed you in our invitation letter, the purpose of this conference is not to arrive at definitive answers or even to reach tentative conclusions. The principal goal is to end the 2 days with a set of clearly identified questions and issues of significant importance to the future of the Indian financial system that interested researchers in India as well as elsewhere can start to explore and present solutions for. In addition to this conference, and we hope others like it, we hope to build a community of individuals who care about these issues and would be willing to be commentators, researchers, and where appropriate, advocates for change. As the business school focused on finance, IFMR hopes to be continued to be closely involved in this research program, and jointly with a group of like-minded institutions and individuals expects to build capacity within the country to examine the issues that emerge from the conversations of these 2 days with a great deal of depth. At this point, our belief is that it's not a good idea to be pragmatic or to begin by acknowledging the political or regulatory constraints that we see before us. The belief is that if we do this exercise with the starting point of a clean sheet of paper, and eventually through the research arrive at a design that is dramatically different from what we see around us currently, then we can put on the lens of pragmatism and weigh the costs and benefits and feasibility of bringing about that change. It is my understanding that Australia, for example, attempted something like this and was able to actually go through and execute a new design completely from scratch. It is my view that many of the recent committees that looked at the future of finance were perhaps too pragmatic and set their sights to points of time no more than 3 to 4 years ahead. In this conference, I am hoping that we will think more grandly and set an agenda for the next 2 decades and not just the next 2 years. I have been associated with the work of most of these committees either directly or indirectly, and have often felt hampered by the absence of good research to guide the work of these committees. Consequently, we've often had to rely on the experiences and gut instincts of committee members to arrive at our conclusions. And while, given the depth of experience that committee members bring to the table, this does produce very good outcomes. It necessarily falls short of the kinds of fundamental design changes that may perhaps be called for. Rupa and I were involved in the 98 Khan Committee report on the future of development finance institutions. Even at that point, while we had the benefit of good work, that at that point new work by Merton that we used quite extensively to think about functional design rather than product-based design. Even then, we felt that there were significant gaps in terms of thinking that perhaps a good research program might have helped us answer. Today in the world, the Indian mini crisis of the microfinance sector also gives us a sense that absence of good data, absence of good research is allowing us or preventing us from reaching good conclusions about what is actually needed. Everybody has a point of view, very strongly held point of view, but often not actually backed by any empirical or theoretical model. And that's what I'm hoping in this conference we will try to address. Wow. One of the reasons why we thought that a conference like this may be useful and maybe a grand agenda kind of thought process may be interesting is, at least in my view, many of the imperatives, historic imperatives, and these imperatives I would trace back to 100 years, that led to the current design of the financial system are perhaps no longer valid, and I'll point out to one or two of them as we go forward. And The belief is that as a uniquely advanced, for those of you that work in the equity markets know that we have perhaps the most modern equity market infrastructure in the world. There are not too many countries, for example, that with the kind of volatility that we see in our systems can still keep markets open and still have a situation in which you do not have defaults. 20 years ago, this was routine to see broker defaults, to see exchanges shut down, and scam after scam hit the system. So in some ways, we are very, very advanced. But in some ways, we are an extremely poor country, which is in need for sustained both rapid and inclusive growth. In my view, we have an opportunity to do things in a way that other countries do not. I also believe, interestingly, that the failure of several of our traditional strategies, such as extensive rural branching, if indeed we had gone out there in the 70s and built out the branch networks that the mandate had required us to, the failure of the development financial institutions, if you see the DFIs that were largely responsible for project finance, have all failed. Some recapitalized because and converted like ICICI into banks. Some continued, but then had to get capital from the government. But the failure of these two big strategies may have ended up creating an opportunity to build something from scratch, because we don't have the legacy now of the massive branch infrastructure, which then we have to undo, because perhaps now we conclude that it's no longer actually necessary. The fact that we are all here and even in our daily lives are actively engaged in the business of finance in one form or another tells us that we do not need to be persuaded that financial services are important. However, just so that we build a shared understanding on this, even at the risk of belaboring an old point, I want to take a few moments to outline why I think financial services are important and what role they play in improving well-being as understood generally. I feel that a shared perspective on the purpose of finance, while not something that we will discuss as a research topic, may help us understand financial systems design with a lot more clarity. It is my belief, and this is something that people in the room may dispute, that there are no definitive prescriptions for making a country grow at a certain rate or to lift people out of poverty. I think that's more a belief perhaps politicians have, that they can do this, that, and the other, and suddenly there will be change. The task, in my view, of growth and poverty alleviation is best left to decisions and choices that myriad firms and individuals make. And the task of policymakers is really an environmental one. That is to identify and build various pieces of institutional infrastructure that can allow these individuals, households, and firms to make the best possible choices, both from their personal points of view and in the aggregate from a national point of view. There is a lot of debate on what constitutes a full complement of high-quality institutional infrastructure. For example, I recently saw a debate on the World Bank blog on whether democracy hinders or helps. I saw it as a classic arm wrestling match between those that believe China's way of doing things is the right way versus those that believe India's way of doing things is the right way. However, unlike perhaps in the question of democracy, there is broad agreement that finance and well-functioning financial markets are an essential part of the institutional infrastructure that enables growth to proceed smoothly and at a rapid pace. As I understand it, well-functioning financial systems allow individuals, households, and firms, and entire countries to, one, think long-term and make investments, both personal, for example, in advanced education, and financial, for example, in municipal finance, that have extremely long horizons. Second, assume risks that they are in the best position to beneficially manage. For example, building hydroelectric power plants in the Himalayas. And shed the risks that they are unable to. For example, credit exposure to vendors or the risk to the movement of the wholesale price index. Three, focus their attention on a few skill sets and activities. For example, building competency in biomedical engineering, and not be required to over-diversify skills to protect themselves against adverse shocks. For example, shifts in the fortunes of the pharmaceutical industry. Four, to get resources at a reasonable price. By that I mean cheap, but no cheaper. To build and grow high-quality businesses. for example, steel plants? Should they have the skills and desire to do so? If not, to have the ability to invest their resources in other businesses or on the larger economy at levels of risk that they are comfortable taking. Not necessarily low risk, but risks that they think they can take. For example, participations in high-risk shipping insurance could be a risk that somebody wants to take on to diversify their portfolio. 5, ensure the day-to-day lives of individuals are smooth and risk-free. So the children can go to school, mothers can live lives without stress, and entire families can sit together and plan for a better future without being beset by unexpected shocks. For example, changes in the cost of a home, or, I'm told this is Sheila's favorite example, the cost of a medical education, which can inflate at prices that are completely out of control of an individual family. 6, receive good guidance on how they might best live their financial lives from well-trained specialists who have the patience to understand their particular circumstances and their plans, dreams, fears, and have the competence to provide them with a sound set of financial tools that modern financial systems have the ability to provide, and to be protected from deliberate or accidental mis-selling by their financial product providers and advisors. For example, inappropriate sale of interest rate derivative products to companies. This is something that those of us that have worked in corporate finance are very familiar as bankers with doing it, and as non-bankers of having been the victim of it. 7, grow as far as their capacities and human and technological resources allow them to, without being bound by the limitations and size of financial systems. And this is something that I will come back to a little bit. But for example, power plants, mining companies, India we felt had enough resources, but perhaps now we're reaching limits of even the modest requirements that are being placed in front of the financial institutions. And I'm sure this is not an exhaustive list. All of you could add to this list many more aspects of well-functioning financial systems. However, there is no question in my mind that on many of these dimensions, our financial system is actually not performing very well. Let me, please allow me to list a few examples. One issue that I mentioned already is that of size. A number of our large companies are unable to access an adequate amount of local currency finance, even though much of their revenue are local currency denominated. There was recently news that 2 of the largest local banks, State Bank of India and ICICI, have already breached exposure limits to one of the large businesses. And this is when we've just gotten started as a country on our growth. The Committee on Urban Infrastructure and Services, of which I was a part, has estimated the total long-term investment requirements of urban infrastructure in India to be about $1 trillion. And it seems very hard to imagine that the financial system would be able to come up with that volume of resources given the size today. Even when compared with China, after adjusting for the relative sizes of economies, the belief is that our financial system is significantly smaller than it needs to be. In my view, in order to realize our potential as an economy, we need a significantly larger financial system with much larger financial institutions. We may come back later to argue, do we need these large financial institutions or not? Are they the cure or the problem? But clearly, something is needed that can support the size of growth or size of requirements of the system. Also, my belief that the limited size of a financial system is one of the key supply side bottlenecks contributing to the cost push inflation that we are currently witnessing here in India. Interestingly, it is the same argument of limited size that is often used for the imposition of priority sector requirements. Because the concern is there are so many interesting opportunities in the market that need financing that there is a very real fear on the part of the regulator that there are sectors of the economy that are important that will not get the attention of banks. So which is why the continuing requirement to push banks to priority sector to force allocate and ration resources between the priority and the non-priority sectors. Second issue is spread of the financial system, and this is something that is not new to people, that we've done many things, including nationalized banks, tried very hard to impose priority sector requirements on insurance companies. The financial system is barely able to reach even the urban population of the country, leave alone the rural population. I was a member of a committee that recently looked at national allocation of resources to for big central schemes like NIGA, like SSA, and we were trying to examine how is it that we make these things much more smooth and leakage free. What was shocking to me is that we, since I was a former member of a bank, could not guarantee that even the panchayats, the schools, and the PHCs have bank accounts. Forget individuals that live in those areas. And we had to pull back on that recommendation because there was no way anybody could assure us that electronic payments could be made at that point. In fact, that committee also recommended that feedback be provided by the schools directly into government systems about whether they receive the money or not. And eventually they hope to make it possible for individuals, students and parents to comment back on the quality of services that they're getting from the schools, all of it reflected into national systems. But we could not guarantee that the fund flow would actually take place in this manner. Scope, we have not finished the task of providing basis of access to basic financial services. Insurance markets have reached a fraction of the country, and equity markets, including mutual funds, I understand, have active participation rates of merely a few 100,000 individuals. Now, this number may be a little bit larger than what I remember it to be, but I think the number would be not, relative to the size of the country, it will still be a very modest number. Innovation, this is something that the trust has been working on for a while now. Farmers are unable to access electronic spot and futures markets in most parts of the country. Products like securitization, credit derivatives, and other modern financial instruments have barely made their presence felt. And despite the fact that one would argue, for example, cotton farmers have repeatedly told us in Gujarat that they need access to options. They do not want just futures. But even if the law allowed options, what we find on the ground to actually get these products out to people is a Herculean task. Integration, even though the target of all selling efforts is the household or the small company, the selling channels, and we are not unique in India on this, but certainly it's a problem that faces us, are highly fragmented with very weak accountability of those offering products to ensure that they're not being missold. It is something that I will hint at a little bit later. My anxiety somewhat is that a lot of the efforts at financial literacy, for example, are being done perhaps with good intent, but in my view have the ultimate kind of feel of shifting blame from providers and regulators to customers. To say, now I've made you financially literate, now it's your problem. I don't have to then worry so much about providers and regulators being held responsible for the fact that bad financial products are being sold, and this kind of ongoing conversation about teaser rates that happen in the market, despite an enormous contribution of this kind of mis-selling to the US crisis, and the back and forth that took place before that product was withdrawn, suggested to me that there is still a sense of, we are not responsible, that the customers make a decision that is appropriate. And the final point on which I think we have perhaps not been as sensitive as we need to is the quality of assets. My sense is that the rising tide of non-performing assets, particularly from priority sectors, and products like Kisan Credit Card, speak to a large bubble on non-performing assets with no sign that there is any resolution in sight. Cooperative banks, regional rural banks, with a few notable exceptions, continue to flounder. And my own personal belief is, and again there may be violent disagreement in the room, that it is not true that we have not had a subprime crisis in India, or that we have not had to resort to taxpayer finance injections of cash to keep the system afloat. The combination of repeated failures of the cooperative banking system and regional rural banks, which have had to be bailed out, the large agricultural loan waiver that we saw, the automatic recapitalization of government-owned banks, the repeated merger of weak banks with strong banks through an artificial scarcity of branch licenses, and the guaranteed profits, which to my mind is a very large number that banks get, and which is what explains why there is so much of desire to become a bank between the repressed savings and current account rates, and which are even below the T-bill rates. To my mind, are some of the examples that suggest how there has been actually a very large and continuous injection of profits inside the banking system to make sure that it stays afloat. One estimate that I had done a while ago for an IMF paper suggested that if you looked at the aggregate profits of the banking system and looked at the difference between the savings account rate and the risk-free rate maturity matched, and the profits that came to the banks from that, the total profits were actually lower than the guaranteed profit that you actually got out of just this limited method. And my sense is there is understandably one of the reasons why there is reluctance to free up that rate, because there is some anxiety that that might actually be much more damaging than we anticipate. So in my view, on many dimensions our financial system has done well, but overall I would like to suggest that there is a long distance for it to go before it becomes a full partner in the growth process of the country. Given this reality, it is possible that we could go on moving as we have done in the past with gradual move backwards and forwards, hoping to build an equilibrium that works for us on many dimensions, politically and other ways. Or we could attempt a fundamental restructuring and begin again from scratch with a completely new design which meets our multiple objectives of systemic stability, economic growth, and financial inclusion. I was a member of a committee that's just filed a report on the pension reform in the country. And there was interesting subtext within that discussion that, do we worry about regulatory turf or not? Or is the goal expand what we do versus what some other regulators actually end up doing? And my sense is, in this environment where there has been a lot of debate about where one type of instrument and one type of regulation goes and how it conflicts with other types, to start with a new regulator and start with new challenges of regulatory confusion suggests that maybe there is need for us to step back and ask the question in a sense afresh. Whether it's politically feasible or not is something we can debate later, and what is the right answer. One of the principal goals of the research agenda ahead of us, in my view, would be to help us answer this question actually carefully. It is my personal view that while each of the steps that we took in the past have been taken with the best of intentions, as a system we find ourselves locked into choices that we made in the past based on imperatives, some of which no longer appear actually relevant. This may well be an opportunity to take a sharp break from the past and begin afresh. And I'm not going to suggest that that's feasible or that's pragmatic. But as I said earlier, my request in these 2 days is for us to try and put that aside a little bit and try to see if we can, dream big dreams. One of the reasons why I feel that this may be a good time to think about fundamental restructuring, there are many of the reasons that led us to the original designs are perhaps no longer as relevant. Let me give you 2 examples that occur to me as big issues. One, my sense is we may be nearing the end of the complete and final digitization of cash in a manner very similar to what happened with the share settlement. You saw, 15 years ago, if you mentioned to somebody that the share certificate would not be there, people would have ridiculed and said, well, what's wrong with it? That's just not going to happen. But thanks to the efforts of, the system and visionary thinkers like Ajay, for example, here that were involved in that overall thought process, we are at a situation today where all of this is actually even in the banking system. The fact that you move in a market that was entirely phone-based to a market in which government securities are now traded in a largely electronic format was a move that I myself was somewhat involved in, and the belief was not going to happen. And I remember a meeting in which one of the banks said that I don't have the money to put up these systems. And I remember the deputy governor at that point, perhaps half in jest, telling the bank that on your way out, why don't you surrender your license and go? Because if you don't have the money to invest in these basic systems, you're not going to be able to participate. We make therefore big moves. My sense is this is going to happen with cash. It doesn't seem entirely obvious, but some of you went and saw what Anil and team are doing on the ground in Tanjavur, for example, and you're starting to see how it is possible, perhaps, in a market that is entirely unbanked, to move away entirely from cash. And my sense is that this, in the foreseeable future, would actually be a trend that will continue. Second, I believe that if you look at the debates and conversations going on, particularly post-2008, but look at the overall decade, a unified understanding of risk and capital allocation is coming across insurance, banking, and securities markets. Maybe 15 years ago, one could argue insurance companies need to be managed differently. People who hold securities need to think about it differently, and banks need to be managed differently. The language of value at risk, the language of stress testing, the language of capital being appropriately required actually has become very common. You participate in separate dialogues, you don't see the fundamental differences that you expected to see a long time ago. And there may be other mega trends. I'm just pointing to two that make sense to me. But equally, we know that several of the older problems of moral hazard, adverse selection, increasing levels of complexity and uncertainty in the real economy, that could whiplash the financial system. The pro-cyclical nature, this is just my view, others do not agree, of markets. It almost seems as if the opacity that financial institutions provided was a beneficial opacity. That too much information produces panics that tend to cycle through the system. Increasing levels of integration in the real sector across the world are very much here to stay. So this is not something that has changed. But if you look at the two mega trends, what are some of the implications on financial systems designs? In my view, some of the institutional boundaries are starting to blur because of the convergence in rules regarding capital and capital allocation techniques. And what we are seeing as unseemly regulatory conflict between regulators who should know better actually perhaps is an indication that the real economy is pushing these things to come out as integrated ideas, and perhaps it's actually the structure that is at fault, and not so much the fact that there are regulators that are trying to fulfill personal ambitions and going over turf. For example, separation of institutions such as banks and insurance companies and placing them under different regulatory regimes that looked sensible at one point we may need to think about, is there an opportunity to rethink some of those questions. Even at the consumer level, there's a lot of functional overlap, and this is not something new. In the book that Morton had written, he had pointed this out a long time ago, but again, you see this in the Indian system, starting to see this much more now. A money market mutual fund as well as savings bank account. As far as the customer is concerned, they have a very similar look and feel. In the US, when they were allowed to collaborate, you saw a flight of deposits from the savings bank account into the money market mutual fund, forcing banks to then offer money market linked instruments within the banking system. In India, using the power of moral suasion, these collaborations have been prevented from actually happening, in part because there is a fear that the bank should do stuff quite strongly. But more recently, there is new understanding, which is suggesting that a lot of the capital adequacy requirements that were perhaps there, or liquidity requirements that were there on banks, may need to be examined for money market mutual funds, because the lender of last resort capability that banks have that allow them to meet runs, or to a degree allow them to hold themselves liquid, maybe money market mutual funds need. And the belief is that the manner in which they went out and hit the financial system to withdraw liquidity in the crisis may have exacerbated some of the problems that we address. The sense is that in any design work that we do, we may have to examine these issues, and it would be nice to examine them from scratch to see, if we were to start again today, what is the design that we think would be important. The digitization of money, in my view, will transform the payments infrastructure. And a number of components of the existing financial architecture, such as traditional bank branches. If you visit a bank branch even today, 60, 70, maybe 80% of the work is counting cash. Counting and storing cash. Getting cash, receiving cash, putting it away, keeping it safe is an enormous part of what a typical bank branch does. It's possible that this function, there will be other functions that banks branches do that are still important, but this function may actually disappear. But you may even see things like ATMs vanish. You may see credit cards and debit cards vanish. If indeed it has become possible to use thumbprint as a way to be recognized, then many of these pieces that we are as a country just about introducing, it may be a good idea that we actually came to it late because we could leapfrog on some of these issues. And as I pointed out earlier, quality of origination of financial assets such as loans and insurance will, however, continue to be relevant because of challenges of adverse selection, moral hazard that will continue to remain significant. So new entrants. Again, it is my belief that we have not seen the big banks of 2050. We don't know who they will be. They may be existing banks, but they may be entirely new players that come about that actually use some of this new understanding to think about where they might go. Because while they may have to invest a lot of energy and resources on the older problems of moral hazard and adverse selection, they may not face the entry barriers of having to set up large branch networks and such like in the system. From a household perspective though, the situation is going to be much more confusing. Not so much because you could always say, in this my understanding, an ongoing debate about should financial products be simple, and is that the direction one should go? Right? My favorite example is if I go to a farmer and I ask him, you have two choices. Right? One is a standard loan that you have to pay back every week, right? No matter what. Good interest rate, yield to maturity is well known to you, everything is well understood. Versus a loan in which I tell him, you pay when the crop cycle is appropriate. If it doesn't rain, you don't have to pay. If commodity prices collapse below a certain number, you don't have to pay. Right? It's entirely possible that the second product is far more useful and in terms of the life of the farmer, a simpler product because it makes, he doesn't have to plan around the loan. But of course, as you can see quickly, that the underlying complexity of in that loan is much higher. There is an embedded commodity option in there. There is an embedded rainfall option in there, and obviously, then the question comes up: which was a simpler product to offer the farmer? And then, of course, this question of should we then rely on financial literacy to solve this problem? My understanding is that there are 5 people in the country that fully understand rainfall insurance. Right? How do you expect to transmit that literacy to every single farmer in the system? Right? Or should we actually think about this from a somewhat different perspective? And as I've told some of you, my new area of work is actually health, and I find a lot of balance between the manner in which health providers, doctors, are held accountable. They don't give you a pharmacopoeia, they don't give you a list of books and say, here is a list of antibiotics. Now you're medically literate, now you figure it out. And I'm not responsible for which antibiotic. And my sense is a rainfall insurance contract or a commodity option contract is as dangerous and as useful as an antibiotic. It depends on what you did with it. In fact, a simple loan, as we have discovered in some of the crises that we have seen recently, because of the enormous leverage that it provides, if used well, can really make your 1 rupee of effort equal to 100 rupees of benefit. If used badly, you can take that 1 rupee and wipe it out with a small shock. And the sense that we have is that, given this emerging scenario, our approach to customer protection that has until now relied on fairly, in my view, naive assumptions regarding the value of financial literacy and has just attempted to shift responsibility away from the regulator and the provider to the customer may have to be revisited. And there may be a need to seriously explore the liability of the provider for a variety of missale scenarios, similar to what is actually already available to corporate customers. I come from a corporate finance background, right? There have been repeated cases now, even in India, in which corporate customers have alleged that they were missold a security, right? Missold a derivative contract, and the law has upheld that position. And somehow, for the retail customer, that we have now not been able to bring. There are lots of challenges in trying to execute this stuff, but it is possible we may have to bite that bullet and bring it all together, rather than saying, let us go for simplicity in the product design itself. Because in some ways, as I heard earlier in some other conference, simplicity is a methodological principle. What is simple is because you say it's simple. It's not quite an underlying design idea. And we may need to re-examine this issue. I have tried to give you kind of a mishmash of issues that, to my mind, are relevant and important. It is entirely possible that this is not the set of issues that are important. And as we think about financial system design, one of the reasons why we have gone out and brought you all together, and I'm so pleased that you took the effort to come all the way, some of you from half around the globe, to be here, is so that we can benefit from this collective wisdom, not to find the answer, but to find the questions. And really the conference format, the goal of my presentation was really more to throw some dust up and to make sure that there are issues in front of us, so that we don't sit in a happy situation to say, all is well, we have escaped the crisis, nothing needs to be done. I would like, my goal of this conference, this presentation was to say, no, that's not the case. Whether you agree with this specific set of problems or not, that's a matter of debate. So the conference format, given kind of blue sky nature, at least right now, of our discussion, we try to keep the format very loosely structured to get the most out of your expertise and perspectives. In order to get the discussion going, in conversation with some of you in the room, somewhat arbitrarily, we have broken up the conference into 3 segments: origination, transmission, and aggregation, as 3 broad buckets of questions. One involving customers, customer protection issues, other involving markets, derivatives, and such like, and the third involving large, nationally important financial institutions and systemic risk concerns. Now, one could argue, and I know there are some people in the room that will argue that conceptually there may be only 2 buckets: origination and transmission, and as represented by markets. But to my mind, there is a distinct role, this is just my personal perspective, for large financial institutions with pools of capital, dark, opaque pools of capital that we are calling aggregators, as the third distinct possibility. Now, we could imagine a future, maybe 50, 20 years from now, where these dark pools and these repositories of large quantum of capital are not necessary, and markets are smoothly clearing risks from one type of customer to another type of customer. I referred in my earlier remarks to shipping insurance participation. I understand this is how the Titanic got insured. That an underwriter sold several $1 billion worth of insurance, but did not hold it on his own books. He found several high net worth individuals to whom these risks were parceled out and privately placed. So in some senses, the role of the aggregator was really not an aggregator, it was just a transmitter. My sense, though, is that the I understand it, that there may still be a role, even in a 20-year scenario, to a large institution. And again, this is something that
what's an OPEC up to?
That is something that we don't know. No, the word is not precisely used, but there is a balance sheet that is not entirely visible. It's something in which, for example, if I hold it in ICICI Bank's balance sheet, you don't exactly know how the capital allocation process worked and how was its security. You can only see my aggregate balance sheet. The way we have structured the conference then is, for each of these segments, we will start with one overview presentation that lays out the scope of each of these 3 areas and evaluates how the Indian financial system is faring on them. Each presentation will conclude by identifying 4 or 5 key themes. Each table at which you are seated will then try to draw out a variety of thoughts of where you think the future should go with this area, and we have tried to use technology, which the idea is it should be enabling. If you find it to be a barrier, please feel free to abandon it. But to make it easier to do, and my colleagues will say more about this. As I have mentioned before, I would strongly encourage you not to limit yourself to seemingly pragmatic rules, not to look ahead and say politically this is feasible, that is not feasible. This is a thought exercise to draw bold ideas. I would also urge you to certainly talk about your pet idea, and I'm sure all of you have one, right? But to try and see to come up with more than one vision, because my sense is then we can turn to the researchers. Several leading ones are in this room to say, help us think about how these actually work out. On day 2, that is tomorrow, what we will do, because we will cycle through all of the issues today in all the 3 areas. And as I told you, this is somewhat an arbitrary bucketing. You may discover as we go through the day that really what we were thinking about the second and third bucket really had a lot to do with the first bucket, and we may, at the end of the day, discover kind of a new framework in which to think about this. On the second day, what we will try to do is to gather all of these ideas and try to identify some cogent research problems and articles that will help us think about these questions. And I'm not suggesting to you, therefore, these pathways will then result in a conference document that we can submit to policymakers 6 months from now. That's not the goal here. We are not a committee that's appointed by anybody. It's a self-organized group of people. My sense is this will then go back to long-term researchers that some of them in this room, some of them outside, like Viral, like Dr. Upadege, who will then start to think about, okay, how do we answer these questions in a systematic manner? And then, the 4 categories that we've thought about, for which we will have to give some answers as we think about this vision. One is, of course, the research itself as to what is required. Second is what kind of new product innovation, new directions systems must go to. Regulation, clearly, there will have to be a point of view on it at the end of the day, because I don't believe it is anybody's case, even the most free market thinkers in this room and now in the country, that entirely absent regulation, one can find self-regulated methods of working. And the 4th issue is public infrastructure. What is the public infrastructure that is needed? Should there be any or not? I'm hoping that these 4 or other dimensions is something that we will debate about tomorrow. Just as a broad kind of guideline or rule, you might say, you're all free to use content from these conference discussions for whatever else that you might want to do. But what I'm told are called Chatham House rules, that neither the identity or the affiliation of the speaker, nor that of any participant, we would request you to repeat. We are not going to record any group discussions. That camera is meant to record only the speech that the keynote speakers will give, because there is a lot of interest amongst a wider community of people as to what are all these people discussing here. But only the speech, which is kind of a prepared format, is what is being recorded for inclusion on the conference website. The discussions itself will be not recorded, and certainly you should be broadly within this guideline to use this material as you want. After the conference, we will circulate to all of you and to those that couldn't be here today a synthesis of what we discovered in the 2 days. The idea, once again, being, I want to emphasize, to spark off more research and more dialogue on this, not to conclude on anything too soon, because there is some anxiety in my mind that we are tempted to find or to suggest the final answer right away. There may be some value to saying, right now, let us suspend judgment on what the final answer is, but put some stuff out on the table. Thank you once again for being here and participating in this important conversation, and I hope you will find that the 2 days
are worth the trouble